what happened yesterday then? Do you think we've got the budget? Obviously, was the big news yesterday.
Yes, just looking. I don't know if you can see this FT sort of front page with this fixing the housing market. Exactly the wrong end of the market. It's a relevant part of the market. The first-time buyers, really, as far as fixing it is concerned. All the stamp duty is at the top. So this was, I thought it was, I wouldn't say pathetic, but it was just inappropriate. And as you can see, the FT with its usual fawning approach. So the Chancellor plays his bad hand cleverly. He played his bad hand badly, as far as I'm concerned. A couple of titles there you can see at the top there. CMC markets. They've been going for about nearly 30 years now, I think, in terms of spread betting and making hay while the sun still shines. The spread betting crackdown, it's sort of gone into the realms of gambling and the moral maze, I think, as far as the nanny state is concerned on that. Still don't understand why there's such a big crackdown on all these derivatives and that sort of area. If people want to lose money, I think they're perfectly entitled to. Obviously, if they want to make it, so they're also entitled to do that as well. So I think things have gone too far in that direction. As anybody who's trying to open up a spread bet or account in the recent past would have known. And the other, I wouldn't say it's Schadenfreude, but something along those lines. Centrica, the owner of British Gas, loses 823,000 household customers in 4 months. Absolutely wonderful news there for people who don't like fat cats and gravy trains and monopolies. So that's my rant for the morning. Hopefully we can go over to Russell Jones, who will deliver some cool-headed analysis of the financial markets.
Good morning,
Russell.
Hiya. Well, there was nothing in the budget for retailers, was there? Obviously, on retailers, with the projection of the economy slowing down, it's going to get tougher for them. In terms of, go on.
No, just saying that's why the FT said the Chancellor played his bad hand cleverly. Obviously, I didn't see anything there which was clever in any way at all, apart from him remaining as Chancellor.
Well, he's not obviously part of Brexit, is he? So obviously they don't want to break up the Tory party, and then we could have a disaster if we have another half a trillion basically going on to GDP costs and everything when we renationalise everything. And yeah,
that's right.
Going back to where we are. America's closed today, so it's going to be a very quiet market. We're expecting that. The FTSE has opened up significantly down. When I say significantly down, it seems to be risk off. It's virtually all red, and it's growing. It's at 40 points down as we speak. Overnight, Asia was fairly quiet until the last 2 hours, but China, over fears of cutting back their investments, so obviously has hit the market there. Shanghai is currently down 2.25, and after hitting an all-time high yesterday, the Hong Kong index is down 1.25. So there's a little bit of a fear there. So I think if we'd had America opening today, we would probably see a further reversal. But America still finished strong yesterday. There's still a chance, obviously, hopefully, of seeing a tax change. But I think the more closer we get to the end of the year, the more fearful I am of a reversal. The budget did have a big impact on house builders, as you possibly saw. It was waiting to see what would happen. The land bank evaluation, which has been threatened in the past, may not happen anyway. And what are you going to do? Take the land off them? I don't think he will.
But yeah, that sounded rather like Comrade Corbyn and friends, the grabbing the land back from these people.
I think it was just propaganda.
Ridiculous.
Just playing to the audience. Berkeley Homes, Barratt, Bovis, Bellway, Persimmon, Taylor, all down between 1.8 and 3.7%. So you saw the six mass markets all falling, including the London one at 2.6. Barratt, which is obviously a greater spread over the UK, was down 3.7%. So will that continue today? Well, when you look at the screens, there is a continuation today. So I don't know if it's not going to be like double-digit drops, but this could be the start of a slide. And if you've got tremendous profits in house building. You've just got to ask yourself what you're going to do now. Do you bank them, or do you still take a risk of holding on?
What does that mean for our friends, the estate agents, do you think, Russell?
Well, they went up yesterday. They went up yesterday, and it was marked by Foxtons, which was the highest increase at 6.6% up. And that's because what they believe, and it came out from the OBR after the budget as well, that house prices will still go up because he won't get the growth in building as what he wants. So the stamp duty for under 300,000 external to London and up to 500,000 in London will purely just be absorbed now into the price with less reductions to the purchaser. So they end up paying the same, just less to the government, more to the seller. And Foxtons then and the other estate agents benefit from their commissions. So that's why the estate agents saw a fillip yesterday. And he's probably right. When you think about 40–50% of the market at the moment is on some form of reduction at time of sale. In London, obviously, you're on a much greater percentage. But I think the stamp duty will literally get absorbed into the price of the property. It'd be easier for people to buy because they're not obviously taking parental loans or whatever out to find it. But until we actually have some form of mass development of skills, there's too much cost involved with labour. So they can't do it. Now, councils hopefully can get some form of social programme, which is desperately needed for the UK. But I think housing as a sector, for what we're talking about, stock market related, will come under more and more pressure. Barrett has just gone positive for the day, but it's 0.2% up. I just do not see this market thriving as it was before. Some of the companies we mentioned yesterday, Sage did open up down, and I did infer that it might do a Kingfisher and turn itself around when it finished 0.9% up. So the results weren't as bad as what the market first envisaged, and there was a turnaround. They're up 1.3% further today. So a solid performance, decent dividend holder, core portfolio kind of buy and hold. Countryside Properties mentioned earlier was up 0.6%. Incidentally, Telford Homes was also up 1.4%, which is a buy to rent in London with lower costs, which obviously benefits from a smaller company too. So you have to be cherry picking if you're going to stay in that sector. Thomas Cook, I didn't mislead you, I just didn't read it properly. And the reason for the major fall yesterday, which was I lost, was 130 basis points drop in the margin related to Spain. So Spanish holidays from Thomas Cook are going to cost approximately 10% more this year, as they've upgraded the estate, they reckon, out there with the hotels, etc., to give a better quality holiday. The Spanish are taking advantage of the fact that no one else wants to go to the likes of Greece because it's full of migrants now. Italy has suffered, but mainly it's the North Africa and the areas which have been like Turkey, which have been impacted by ISIS. Charles Stanley, although decent results yesterday, finished 6.2% down, and that was because of the forward guidance. They reckon that, like we heard of the big American companies, they're just not going to do enough for transactions with the public. Biffa went up 1.9%. Biffa this morning is up again 0.8%. So obviously that tracks ahead. The three companies I wanted to look at today, and only three, and I'll be brief. There's two interims which have come out. One was Majestic Wine, which I mentioned yesterday. They opened up about 4% up, and they're up 4.3% as we speak now. So if you had bought it, I bought about 150k in that yesterday, and I still think there's further to run. Now, obviously, it's a recovery stock. That's why it's up 35% for the year prior to this morning. Its results are quite solid and nothing spectacular, but as I say, it's a recovery. So all of their sectors have increased in profitability. They're not a massive turnover because they only going to foresee hitting 500 million this year, but they separated over three divisions. The retail, which most people are commonly aware of, 210 branches in the UK and 2 in France. But a big change they did some months ago, which will really have a big impact from retail, is that they almost created like a franchise situation, because the normal kind of remuneration for, say, a branch manager in Majestic Wine, and if you've ever been in there, there's only 2 or 3 individuals in there, but they really do know their stuff. But they were only earning about 30k, so not a lot of money. The incentivization now is they take part of the profits, which obviously makes them motivated, and an average remuneration now should be in excess of 50k. So for running a very small square footage unit with a very slow customer flow, specializing on an excellent service, I think that's going to really increase spend even further, but it's gradual. The revenues are up overall by 5.7%, and 4.2% was the like-for-like. So it's gradual. The other parts of the company, Naked Wines and Majestic Commercial and Trade Supply, were also up, but obviously less impactful in terms of what we see. But all 3 divisions up, and margins were up as well. The investors.
I'm sending my CV along, Russell.
Sorry,
Russell, I'm sending my CV along to Majestic Wines. I think a branch manager would be.
Yeah, well, you've got to do a lot of tasting, haven't you, Zach? So obviously I can understand that. It was like a pub landlord drinking the profits.
Yes, and then after doing the show, I can just go over there, can't I? Really?
You can just stay there. You just sleep there.
Okay.
Okay. Right. The other company which is on an interim, which I want to look up, was Mothercare. Now, obviously, the retail sector didn't have any benefit from the budget yesterday. I know they're going to change the way they measure business rates with inflation, but that's 2 years away. So by that time, the Death Star Amazon would have had a further wipeout of some organisations. Now, Mothercare's half-year report, very brief. They're saying they've had great improvements and they're moving forward. The UK like-for-like sales are up 2.5%. Online sales are up a measly 5.3%. Now, what is interesting when you read through the half-year report is that they're now saying that 97 of their stores are in the modern club format. So obviously some of their expenditure, why they've gone from a net profit in the same period last year of 5.9 million to a loss of 0.7 million as of this morning, is because they're doing this refurbishment program. But they're saying that of those 97 stores, that represents only 75% of the estate. And if you look at the results, which I said they're going to be, they're down 16.5% this morning. So there's a massive drop. And what's interesting is obviously this is one of the major shorters on the market. This company, I think, has got a chance of going bust. Because when you read through it, from experience of what you see is that when they're tied into leases, which they can't get out of with landlords, and they're paying high rent, which is not going down, unless they went into an IVA form of arrangement with paying off their rent, because when they get to the likes of March, and you've then gone through all the Christmas sales, and the retail goes absolutely dead, the cash flow circumstances, which killed off Kingfisher and MFI, means that companies like this will struggle to have floating cash to survive. Now, they've said their target is 80 to 100 stores. So just doing the mathematics, if 97 stores is only 75% of the estate, there's a significant number of stores still to close. They closed 10 stores in this period and opened 1. So I would dare say that the vast proportion of over a third of their stores are loss makers, and they are just basically waiting for the rents to finish off so they can get out of them before they die. So I think this is a terrible statement.
Russell,
that's only my observation of it.
Well, I think that seems quite comprehensive, but the whole point here, isn't it, that Mothercare is just a defunct concept, defunct brand. It's like something from the 60s or 70s, and along with the general retail malaise, it's looking down the barrel.
Well, you know, who would want to buy it? You know, if someone took it over, they'd basically, if it was a large, like if Ashley took over House of Fraser, which House of Fraser has only made 3.4 million profit to April of this year, which tells you they're in a hell of a mess. The investment which never came in from China, and the company still cannot compete head on with another company which we always see as a brand, which is John Lewis. So House of Fraser survives by discounts. You'd put Mothercare in a corner of House of Fraser. I wouldn't bother going into debitors because they're going to go bust as well. So they've got no cash flow there. So Mothercare, I think, is a doomed retailer. I reckon the share price of that will go to next to nothing next year if it survives. That's only my prediction, and always do your own research, as they say. But that's what I think on that.
I think the share price says it all, really, doesn't it?
Well, it's going to continue though. It's a falling knife. It's absolutely fallen. There's nothing to hold it up. Okay, there was only one final today, which obviously some of us may be aware of what they do. Paragon Banking. Paragon Banking, they're up 27% for the year, so pretty strong performances. Brokerages, pretty good broker coverages in terms of buy and overperform, as well as some holds. There's no sales there at all. It's known as a debt repurchaser. So obviously when we went to the credit crunch and people obviously needed to get out of individual voluntary arrangements, etc., they would loan people money to pay off those kind of costs. The buy-to-let market is obviously also their sector. So they may see a slowdown there with the cost to landlords. Some people obviously being reticent of paying such a large cost with stamp duty, etc. However, they've come in with a 1% profit increase, 145 million compared to last year. It's only a small increase, but obviously it's good. Earnings per share are up 6.4%. Return on investment 13.4. Final dividends 11p. Add into the interim makes it 15.7, 16.3% up. Market doesn't seem in a down market this morning. It's up almost 1% as we stand. But again, this is not going to excite anyone in terms of a trading stock. But if it's an investment buy and hold, it's one that someone might go for. But there's so many you can choose from in that kind of format. Yeah. So I've only got 3 today. A lot briefer than yesterday, which would be sympathetic for some. Anything you want to ask me, Zach?
No, I think that's quite a nice little update. Obviously, we are thinned out by the Thanksgiving and looking forward to wasting money on Black Friday. But I think it's a quieter day, and we've got a bit of a vacuum after the budget. There's always a lot of hype ahead of that, and things have. I
think the two main sectors we need to look at. Retail is going to go through a massive problem next year, and when you look at Short Tracker, for instance, and you look at the stocks which are at the top of it, I said before, but the vast majority of retail, not just supermarkets. I think Sainsbury's is in trouble. I think that purchase of Argos was a stupid purchase. They bought something which has been dominated by Amazon. And they've done it for distribution reasons, but the cost is going to. They've already laid off staff since, haven't they? Because they've got a cost issue now. So anyhow, I'll leave you be. But as we speak, Majestic Wine is now up 5%. So I'm going to start doing a little bit of trading this morning, which is where I make my money. And Mothercare is 18% down. So good luck to Mothercare.
Yes, and good luck to Centrica as well. Those 823,000 people gone in the last 4 months, obviously taking its toll. Another company which is close to my heart, the all bar one owner, Mitchells & Butler, also down, which seem to be about right given the type of experience, customer experience they tend to serve up in their food. And so it is rather chunky on the downside, I think, in terms of these movers. Telecommunications also down after its recent woes. Interestingly enough, if you're the chairman of CMC, you'll know that the market celebrated your departure with a 6% rise for the shares. Maybe you should have left a bit earlier. On the other side, just looking at the FTSE 100 stocks, we can get that up just to sort of filter the market a bit. I'm presuming there won't be too many big rises today. What are your favourite blue chips at the moment, Russell? Just as a final question.
I still like the miners, even though there's a clawback in China. I still like the miners. I think as in terms of in the banking sector, if you want a dividend, it's not Lloyd, it's HSBC because they got virtually all their earnings in Asia. Standard Charter is a recovery. On the miners, I've had a change in my life from Glencoe, definitely. AAL is strong. Rio is always strong, dividends. But I think BHP Billiton is undervalued, and because it's got a lot of, it's going to sell off under pressure from investors. Their oil, their shale oil, but I still think it's only had a minor increase compared to the rest of the estate. But I think Glencore will buy Bunge. It was interesting yesterday in the FT. Bunge, if you're not aware of it, is an agricultural commodity supplier in the US of A. Obviously, Glassenberg, which is probably the best poker player ever, who's got ties in with oil from Russia, Libya, Iraq, Iran, Qatar. So obviously he's quite a character. And everything they do in Congo, obviously with the reevaluation of how they pay people backhanders, doesn't matter. Glencore is going to be the biggest trader in all its sectors, but it hasn't got agriculture. Bunge has now done a 2-year payments agreement with its 5 main directors, not just the number one. So if they are taken over, and they're in a hands-off agreement with Glencore at the moment, it means Glencore then will pick up the agricultural side of Bunge in America, increases its trading arm in that sector. It's 50% of the cost of the takeover will be paid by the pension holders of the Canadian companies, so it hasn't got the cost outlay, so it doesn't increase its debt. I still think Glencore is going to be a £4.50 stock this time next year.
On that happy note, Russell Jones, private investor, thank you very much for joining us today.
Thank you, Russell. Zach, we've got John in the room from sharetalk.com. He's going to be telling us about the enterprise software company, BLUR, today. John, good morning. I think I've already unmuted your microphone, so we can hear you if you're there.
Good morning, Simon. Good morning, Zach.
Morning, John. How are you?
I'm very good. It's actually my day off today, but I thought I'd just drop in and speak to you guys anyway.
My day off every day.
So we're going to have a look at Blur Group PLC this morning. Don't know.
So we're going to look at IMRS, but obviously we can't do that.
No, you can do that. But yeah, so Blur Group PLC, they've had a number of issues over the last 6 months. They're an enterprise software provider. Essentially, they provide a sort of supply chain management solution, which many suppliers, as to the size of your Tesco's and Kia groups and blue chip organizations like that, use for in-house supplier management. But they also have a kind of external platform where any man and his dog can tender and bid for various contracts. They do a lot in the US as well. You see from the website that most of it is actually based in the US. But they were a breaking point a few months ago. Were very close to going bust. CFO left. They did a placing of 1.2 million at 4 pence. That completed successfully. They've steadied the ship. They've really cut a lot of costs and become a lot more leaner as a company. But they've never had a problem in winning business. It's the size of the business and how profitable it is that I guess has been the issue. So the numbers have obviously stacked up with today's trading update that's come out this morning. And essentially what we can see from today's update is that they've now got 2.7 million cash in the bank as of yesterday. So they're well ahead of expectations. I know this is a phrase that's quite widely thrown about on the markets, but from where they were, and you've also got to remember back in March, these guys were sort of heading up the dizzy heights of 17 pence. So where they were from doing their placing at 4p, I think they're around 5p at the moment, probably up about 5%. So last time I looked, I see this as a very strong recovery play, because I think their outgoings have been cut considerably, and I think it's a very profitable business if they can continue to grow and keep this marketplace software going, because I think on the face of it, it looks, as far as software companies go, I find this one quite easy to understand what they're doing. I mean, when I first looked at it, I actually did a lot of comparisons with EG Solutions, which was another company we covered a lot, EGS, which also deliver sort of enterprise software. But in terms of what EGS do, and EGS, a very successful company, recently been bought out, and what Blur do, I find on the face of it, Blur's an easier business model for a layman like myself to understand. I mean, how do you see the charts there, Zach?
Well, obviously it's been rather painful. The good thing, I suppose, and this is really nitpicking, but the good thing here with the recent past since the beginning of last month is the way the shares have been hovering at or above the 50-day average. So that's when you're in a weak situation, let's say, sustained price action above that blue 50-day line tends to be the first sign of things improving. Something we didn't get with Carillion in the 40s the other week. So I think, with signs of stabilization, let's say.
Yeah, I think one of the things it's got going for it, it's got a number of large sort of sticky holders, so it's not the shares are not changing hands too often, so it's consolidated pretty well, I think. But today's news, it needs a bit more detail on the bone. If you read the RNS, it's probably less than 200 words. But I think if we can see some more juicy sort of contract wins coming out, I think this is we could get back to 10p sooner than you think.
And I mean, is it basically a value play, or is it how would you class this at the moment?
Well, I mean, I would call it a recovery play personally. I think from they were just under just around 4p at the point of about to go bust with virtually no money in the bank. PR company jumped ship, probably because they couldn't afford to be paid, so fair enough. But
first people to go,
But I mean, yeah, well, no, I mean that's very common. Marketing's always the first budget to go, really. But I mean, I think that's completely the wrong. Personally, as a marketeer, obviously, I would say this, but I think that's the worst thing a business can do, because if you're not marketing, then you're not getting your story out there, and you're not, marketing is all about sales ultimately. It's communications that lead to sales. That's pretty much your definition of marketing. So if you get rid of that, then you're lessening your ability to sell. So they've obviously still managed to do that, because I think they had a good core group of existing clients, and they're doing a lot of work with local authorities. So I think it's a pretty strong company, but I think they need to sell their story a bit more. I mean, if you want to find out a bit more about them, we actually interviewed them back in March, with the CFO who's actually no longer there, but it'll give you probably a better overview of the company than I've just given you. But if you go in sharetalk.com and type in Blur on the search window, you'll find our podcast from back in March.
Well, thank you very much, John. Hopefully we'll speak to you at the same time tomorrow.
No, but one thing just to add quickly, Zach, at some point, I'll give it maybe a couple of weeks, but at some point we'll go back and revisit some of these stocks, but I want to give them a few weeks at least first, and then we can check back and see how they're doing.
I think that's very honest of you.
I wouldn't be anything else, Zach.
I know that. All right, thank you very much indeed. Have a great day.
Thank you, Simon.
Okay, folks, just a quick rundown of the major markets. Obviously, I know a lot of people trading indices and FX. I think what was stuck in my mind was yesterday's negative call on the DAX and the indices from Carol Harmer. In fact, she was negative on the indices and positive on the dollar. And basically, as if by magic, that's what's panned out on the half. Well, this is the 50-minute chart of the FTSE, but classic head and shoulders pattern there with a breakdown through what 73.90, something like that. So an implied target there, which is a rather low one, while we remain below the 73.90 level. But an interesting setup there anyway, in the sense that the break of that neckline would get many intraday traders short. DAX, I think, is possibly even worse at the moment. So we were speaking, I think, yesterday when the DAX was somewhere up here. Obviously, we've had a little bit of a bounce after a near vertical drop, but that's a other head and shoulders type breakdown. A bit of more of a bounce there for the DAX, so worth watching out to see whether it can get back above the 13,000 level. Bounced just above the first support level, 12,890 to start the day. So slightly in recovery mode there, but obviously we've had a more bearish tone come in. As far as the currencies are concerned, great move higher for the euro over the last 24 hours. I suppose the show yesterday was around, we were around 117.50, something like that. We did get a final dip towards 17.30, but nothing below the 17 level, which we were discussing as well. And at the moment, it just looks as though this market heading very comfortably higher, extended bull flag here, and one would expect probably more moves towards the 119 area by the end of the day, especially given that the US is quite quiet, and the market, these markets can skate higher or skate around quite sharply and make exaggerated moves. Finishing off with the cable after the real excitement of the budget yesterday, was sort of buying into that, I think, mostly in the immediate aftermath. Looks like we're sort of topping out around the 133 to 133.20 area. I think we were looking for at least a retest of that 132.80, which we got obviously later yesterday. So it's just a matter of seeing how far we'll pull back, maybe towards that pivot level 132.88. Might be a dip to buy into for day traders today. But that's it for me, Simon. Hopefully everybody can join us tomorrow after your big day today.
Thank you, Zach. Yes, we do have the big monthly summit today, starting off with Fotis, who actually joined us last week on the morning show. He'll be starting at 9 o'clock on the other channel, as they say. So, Zach, thank you very much for joining us. Enjoy your day, and we'll look forward to speaking to you again in the morning.
Thank you very much, Simon.